Welcome back to Bitcoin Dorks, your go-to channel for daily updates on the cryptocurrency market and the latest news. In today's video, we'll be discussing the recent developments in the European Union's cryptocurrency regulations. The European Parliament has recently approved new rules that aim to regulate the cryptocurrency market and protect consumers. The new rules will require all cryptocurrency firms to obtain licenses to operate in the EU and will also impose stricter rules on fund transfers. These new rules have stating its intentions to create a comprehensive regulatory framework for cryptocurrencies in 2018. The approval of these new rules is a significant step forward in achieving that goal. So, what do these new rules mean for cryptocurrency firms operating in the EU? Firstly, they will need to obtain licenses from national regulators to operate. The licensing process will require firms to meet certain criteria, such as having a minimum capital requirement, having adequate risk management procedures in place, and having robust IT and cybersecurity systems. This new licensing requirement is expected to increase the legitimacy of the cryptocurrency market and reduce the number of scams and fraudulent activities. It will also make it easier to identify. In addition to the licensing requirement, the new rules also include stricter rules on fund transfers. Cryptocurrency firms will be required to follow the same anti-money laundering, AML, and counterterrorism financing, CTF, rules as traditional financial institutions. This means that they will need to conduct due diligence on their customers and report any suspicious transactions to the authorities. The new rules also aim to increase transparency in the cryptocurrency market. Cryptocurrency firms will need to disclose information about the ownership structure, the assets they hold, and the risks associated with investing in their products. So, what are the implications of these new rules for the cryptocurrency market as a whole? It's likely to lead to consolidation in the industry, with smaller firms struggling to meet the licensing requirements and being forced to shut down. This may lead to a more centralized market, with larger firms dominating the additional investment in the cryptocurrency market. As the market becomes more regulated and less risky, more traditional financial institutions may start to invest in cryptocurrencies, leading to increased demand and higher prices. One of the most significant aspects of the new rules is the requirement for cryptocurrency firms to obtain licenses to operate in the. This is a major departure from the current situation where many firms operate without any regulatory oversight. To qualify for licensure, businesses must fulfill many requirements, including possessing the necessary capital, implementing effective risk management policies, and putting in place reliable IT and cybersecurity systems. These requirements are intended to strengthen the market's authenticity and lower the likelihood of fraud and scams. However, some critics have raised concerns that the licensing requirements may be too onerous for smaller firms and could lead to a more centralized market dominated by larger players. This is a legitimate concern, as the cryptocurrency market has traditionally been a space for smaller, more innovative firms to compete with larger incumbents. Another important component of the new regulations is that they must ensure that cryptocurrency firms adhere to the same anti-money laundering, AML, and counterterrorism financing, CTF, requirements as traditional financial institutions. This is an important step that will increase market transparency for cryptocurrencies and lower the risk of money laundering and terrorism financing. Cryptocurrency firms will need to conduct due diligence on their customers and report any suspicious transactions to the authorities. This is a significant departure from the current situation where many cryptocurrency transactions take place anonymously and without any regulatory oversight. However, some critics have raised concerns that the new rules may be too restrictive and may stifle innovation in the cryptocurrency market. They argue that the very nature of cryptocurrencies, with their decentralized and anonymous nature, makes it difficult to impose traditional regulatory frameworks. It remains to be seen how effective the new rules will be in regulating the cryptocurrency market. There is no doubt that they represent a significant. One potential positive outcome of the new rules is that they may lead to increased institutional investment in the cryptocurrency market. As the market becomes more regulated and less risky, more traditional financial institutions may start to invest in cryptocurrencies, leading to increased demand and higher prices. However, it is important to note that the cryptocurrency market is still highly speculative and volatile, and investors should exercise caution and do their research before investing. The new rules may increase the legitimacy and transparency of the market, but they do not eliminate the risks associated with investing in cryptocurrencies. Overall, the approval of these new rules by the European Parliament represents a significant step forward in the regulation of the cryptocurrency market. It remains to be seen how effective they will be in achieving their goals, but they are undoubtedly a step in the right direction toward increasing the legitimacy and transparency of the market. That's all for today's update on the EU's new cryptocurrency regulations. Make sure to hit the subscribe button and the notification bell so you don't miss out on our daily updates.